You sit there, staring at the chart, thinking the next candle will give you permission. But the market doesn't give permission. It tests conviction. And the truth is, most traders are not losing because they can't read charts. They're losing because they don't understand the moment of entry. That single decision, that precise second, where fear and logic collide. You've watched our video on the truth about support and resistance. You've studied the three-step A+ supply and demand strategy that actually works. You've even gone through the chart patterns that predict market movement. And yet, when it comes time to pull the trigger, hesitation creeps in. Why? Because knowing where price might go is not the same as knowing when to enter. And today, we fix that. Before we go deeper, subscribe to this channel, like this video, and leave a comment below. Tell me the one mistake you make most when entering trades. And if you're serious about mastering this game, the link in the description will take you to our ebook, Thinking Like Jesse Livermor, Mastering the Market with Discipline, Patience, and Risk, and the Livermore Journal, a 90-day trading psychology workbook. Check the description now, because what we're about to discuss is not just strategy, it's transformation. Now, listen carefully, because this is where amateurs and professionals part ways. The amateur looks at a candlestick and sees shapes, a hammer, a doji, a bullish engulfing. The professional sees behavior. He sees hesitation, he sees aggression, he sees trapped traders, and more importantly, he sees opportunity forming in real time. A candlestick is not a signal, it is a story. And if you don't learn how to read that story, you will always be late. Let me tell you something I learned the hard way. The market never rewards anticipation. It rewards confirmation. Most traders enter because they think price will reverse. They guess, they predict, they hope. But hope is not a strategy. Hope is expensive. A professional waits. He watches how price reacts at a level. Not just that it reaches a level, but what it does there. Does it stall? Does it reject? Does it explode? That is the difference. And to understand that difference, you have to understand what a candlestick is actually made of. Every candle you see on your screen is a complete battle. The open is where the fight began. The high and the low are the extremes of aggression, how far each side pushed before being turned back. And the close is who won. 4 data points, 1 story. And within that story, 2 things matter more than anything else. The body and the wick. The body tells you who controlled the session. A wide body price closing far from where it opened means one side dominated completely. No contest, no hesitation, pure conviction. But the wick tells you who tried to control the session and failed. That thin line reaching above or below the body is not decoration. It is evidence of rejection. A long upper wick means buyers pushed price aggressively upward and were turned away. Sellers came in with enough force to reverse the entire advance before the close. That is not random. That is deliberate. That is institutional money defending a level. A long lower wick means sellers drove price down and buyers absorbed every unit of that selling and pushed back. The longer that wick, the more violent the rejection, the more decisive the buyers were. Take a simple example. Price reaches a key resistance. The amateur sells immediately. It's resistance, he says. But the professional waits for the candle to speak. If that candle shows rejection, long wick, strong close away from the level, that's information. But if price lingers, if the candles grow smaller, if buyers keep pushing, then resistance is not resistance anymore. It's a trap. And the professional knows this. He doesn't trade levels. He trades reactions. This is why so many traders feel like the market is hunting them, because they enter at levels, while professionals enter at behavior. The candle is not the entry. The confirmation within the candle is the entry. And this is where discipline comes in, because you will be tempted, over and over again, to jump early. You'll see a level, you'll feel the urge. You'll think, if I don't enter now, I'll miss it. But missing a trade is nothing. Entering the wrong trade, that's everything. Because one bad entry leads to hesitation, Hesitation leads to inconsistency, and inconsistency destroys accounts. Now think about this. How many times have you entered a trade only for price to move against you just before going in your direction? That's not bad luck. That's bad timing. And timing is everything. The professional understands that the market moves in phases: accumulation, expansion, distribution. Entries are not made in the middle of chaos. They are made at the edge of clarity, right where uncertainty turns into direction, and candlesticks are the language of that transition. A strong bullish candle after rejection is not just a candle. It is a statement. It says, buyers have taken control. But here's where most traders fail. They see the candle, but they don't see the context. Because a bullish candle in the wrong place is just noise. But a bullish candle at the right level, after the right build-up, is opportunity. And this is why you must combine everything you've learned. Support and resistance, supply and demand, chart patterns. They are not separate tools. They are pieces of the same puzzle. And the candlestick is the moment that puzzle comes together. Now, let's go deeper. Because understanding that you should wait for confirmation is one thing. Knowing exactly what confirmation looks like, that's another. And this is where most traders stay stuck for years. They understand the concept. They nod their heads. They say, yes, I'll wait. And then the next trade comes, and they jump in early. Again. Why does this keep happening? Because they've never been taught to read the specific language inside the candle. Not the shape, not the color, the language. So let's fix that right now. We've already established that the wick is evidence of rejection. But I want to take you further into the three specific formations that, when found in the right location, give the professional trader his clearest entry signals. The first is the pin bar. A pin bar is a candle with a very small body and a very long wick in one direction. A bullish pin bar, small body near the top, long wick reaching downward, is a story of buyers who absorbed every unit of selling thrown at them and then drove price back up before the close. The wick is the battlefield. The close is the victory. When that candle forms at a key demand zone, the kind we identified together in the three-step A+ supply and demand strategy that actually works, you are not looking at noise. You are looking at institutional money defending a level it has defended before. And you don't fight institutional money. You follow it. The second formation is the engulfing candle. This is a two-candle sequence, and it is one of the most powerful signals in technical analysis when location is right. A bullish engulfing forms when a bearish candle is followed by a bullish candle whose body completely swallows the previous candle's body. What does that mean in plain terms? It means all the selling of the previous session was not just absorbed, it was overwhelmed. Buyers came in with enough force to reverse the entire prior move and then exceed it. Think about what that does to the traders on the wrong side. The sellers who entered on that bearish candle are now underwater. They begin to exit. Their exits add fuel to the buying. The sellers become the buyers, and the move accelerates. When you see that pattern forming at a demand zone, after a structured decline, with increasing candle size on the bullish bar, that is not a setup, that is a conviction trade. The third formation is the one most misunderstood of all. The doji. Beginners see a doji where open and close are nearly identical, forming a cross-like shape and immediately declare reversal. That is not what a doji means. A doji means indecision. Neither buyers nor sellers won. The battle was a draw. Whether that draw is significant depends entirely on what preceded it. A doji after a long sustained uptrend, at a key resistance level, with wicks extending in both directions, that is meaningful indecision. That is the market beginning to question itself. That is a warning worth watching. But a doji in the middle of a choppy, ranging market? That tells you nothing, except that the market is ranging, which you already knew. Here's the principle I want locked in your mind. No candle has meaning in isolation. You must always ask, where did this form? What came before it? Is this location significant? What would have to happen for this signal to be wrong? That last question is the most important of all. Because before you enter any trade, you must know where you are wrong. Not approximately, exactly. The price beyond which your analysis no longer holds. That is your stop loss. And your stop loss is not a failure plan. It is the foundation of your entire edge. Now let me show you something that separates the truly professional trader from everyone else. Most traders look at effort. The professional also looks at result. When a large bearish candle forms wide body, significant range, that is effort, sellers worked hard to push price down. But watch what happens next. If price barely moves lower on the following candles, if the effort produced almost no result, sellers are exhausted. The supply driving price down is thinning. And when supply exhausts, what fills the void? Demand, buyers. And that is exactly where a professional begins to prepare. This is also why I keep directing you back to the chart patterns that predict market movement. Because the patterns in that video, the flags, the double bottoms, the head and shoulders, those are the containers that hold this energy. They show you where effort is collapsing and where the breakout is building. The candlestick is the trigger. The pattern is the setup. The zone is the location. You need all three. Now I want to address something directly. The reason most retail traders never find consistency is not that they lack intelligence. It is that they treat candlestick reading as a mechanical system. If I see X pattern, I enter. If I see Y pattern, I exit. The market is not a machine. It is made of human beings. Fearful, greedy, reactive, sometimes irrational. Your job is not to follow a rule book. Your job is to read the psychology of the crowd, as expressed through price. When a candle closes as a strong bullish bar wide body, close near the high, minimal upper wick buyers were in complete control from open to close. No hesitation, no meaningful resistance. That is momentum. When that kind of candle breaks through a resistance level that has held price back multiple times, as we discussed in The Truth About Support and Resistance, that is a breakout worth respecting. Not because of the pattern, because of what the pattern represents. Conviction overcoming resistance. Demand overwhelming supply. Professionals executing. And if you are not in that trade, it is because you were waiting for more confirmation that never came. That is the cost of reading candles mechanically instead of reading them contextually. Now pause here. If this channel is giving you something that other content isn't a real, layered, honest education on how markets work, then share this video right now. Send it to one trader who is struggling with entries, because the reason most traders fail is not ability, it's incomplete information. Subscribe if you haven't, like this video, and go to the description and get both ebooks. Thinking Like Jesse Livermor, the philosophy behind every professional decision. The Livermore Journal, 90 Days of Structured Practice to Wire That Philosophy into Your Trading. They work together. Like these concepts work together. The description link is there waiting for you. Now understand this. Everything we've covered, the wicks, the bodies, the closes, the formations, the context, it all leads to one place. The moment of entry. And that moment is not a location on a chart. It is a state of clarity. The second when you stop asking, should I, and start saying now. Not because you're certain. Certainty doesn't exist in trading. But because the evidence has crossed your threshold. Because the story the candles are telling finally has an ending you recognize. Let me walk you through what a professional entry looks like from identification to execution. It starts before the candle even forms. Price is approaching a zone, a demand zone, a level you've been watching. You've marked it. You've studied how it formed. You know it's significant because of what launched from there before the sharp move away, the imbalance left behind. You know this because you watched the 3-step A+ supply and demand strategy that actually works. You know what a high-quality zone looks like. Now you wait. Price begins to slow as it approaches. The candles compress. The range tightens. Sellers are pushing, but the conviction is thinning. Each bearish candle is producing less and less result for the same amount of effort. This is accumulation. Invisible to most traders, visible to you. Because you are not watching price, you are watching behavior. Then it happens. Price dips into the zone. A wick reaches down, testing the level, searching for sellers, and finds none, because the buyers are already there, quietly, patiently, absorbing everything. And then the candle closes. Strong, back above the zone. Wide body, minimal upper wick, close near the high. Wick, body, close, all saying the same thing. Buyers are in control. That is when you enter. Not a moment before, not a moment after. Now let's talk about what happens after the entry, because this is where most traders surrender every edge they just earned. You've entered correctly. Price begins to move in your favor. And immediately, doubt arrives. Maybe I should take profit now. What if this reverses? I'll just move my stop to break even to protect myself. And in doing that, you undo everything. Because the market always tests your entry. Always. It will pull back. It will pause. It will make you feel like you were wrong. And if your conviction isn't rooted in a process you trust, fear will make every decision for you. That is why psychology is not optional. That is why the Livermore Journal exists. 90 days, structured daily exercises, documented trades, honest post-analysis. Not a book you read. A book you live, because the entry is technical. But the holding, the discipline to let a trade develop when everything in you wants to exit, that is psychological. And it cannot be taught in a single video. It must be built, day by day, decision by decision. Now let me tell you the thing that might be the most important sentence in this entire video. The entry is not the goal. The entry is the beginning. Most traders obsess over entries because they believe the perfect entry eliminates risk. But risk cannot be eliminated. It can only be managed. And the professional trader's edge is not in finding perfect entries. It is in finding entries where the reward is large enough and the risk is defined enough that over time, the math works in their favor. That is the game. Not prediction, not perfection. Probability, consistency, discipline. And candlesticks are the tool that gives you that edge when you read them correctly, in the right locations, within the right context, using everything you've built on this channel. So go back and watch the 3-step A+ supply and demand strategy that actually works. This time, focus specifically on the entry candle that forms when price returns to the zone. That is where today's lesson lives inside that video. Revisit the truth about support and resistance. Pay attention to how candles behave on each test of a key level. Notice the wicks getting shorter. Notice the closes getting stronger. Notice the difference between a level that holds and one that breaks. Study the chart patterns that predict market movement. Look for the confirmation candle that appears as the pattern completes, because that candle is the bridge between the pattern and the trade. Each video is a piece. Today's lesson is the piece that connects all the others. Now, the next time you sit in front of that chart, don't look for signals. Listen for the story. Watch the candles breathe. Watch sellers exhaust themselves. Watch buyers absorb. And wait. Wait for the moment when the story becomes undeniable. When the wick tells you rejection happened. When the body tells you conviction arrived. When the close tells you the verdict is in. And then act. Not out of fear. Not out of greed. Not because you're afraid of missing the move. But because the market spoke. And you understood exactly what it said. That is the art of the entry. And once you master it, not just as an idea, but as a practice, in real time, under real pressure, with real money on the line, everything changes. Your confidence changes. Your consistency changes. Your results change. Subscribe to this channel. Every video we release adds another layer to the complete system you are building. You don't want to miss what's coming next. Like this video. 1 second. It helps more traders find this content, and that matters. Share it. Someone in your world is struggling with entries right now. This video could be the turning point for them. Leave a comment below. Tell me what you see differently now when you look at a candlestick. I read every single one, and your answers shape what we teach next. And go to the description right now. Get thinking like Jesse Livermor and the Livermore Journal. a 90-day trading psychology workbook. Both links are there. Because knowledge without execution is entertainment. And you didn't come here to be entertained. You came here to become a professional. Now go and do the work. The market is waiting. And for the first time, so are you.